everyone. Welcome to FM with Sir Evans. In today's session, we will discuss the sixth competency in the syllabus of ICA Paper 2.4, Financial Management. Let's get started. Working capital is the net current assets or net current operating assets required to support the everyday operations of a business. It must invest in inventories, raise short-term investments, operating finance, and manage credit sales. So current assets, which is made up of inventory, trade receivables, short-term investments, and cash, minus current liabilities, which is made up of bank overdraft, trade payables, other current liabilities, will be equal to working capital. So we'll look at some objectives of working capital management. Is to ensure that investment in working capital is not excessive, and there is enough working capital is available to support operating activities. Where surplus cash arises, investments with suitable returns and no undue risk must be engaged, and they should be converted to cash when it is required. So the entity must avoid excessive working capital. So working capital is financed by long-term capital, that's equity or debt, which has a cost and no additional financial return is earned when there is excess inventory or trade receivables. You should also avoid a liquidity problem. This is where there are shortages in working capital. So liabilities cannot be settled when they fall due, and this can result in insolvency. So there is therefore that conflict of over or under investments in working capital. Hence, we have working capital management. And the amount to invest in working capital depends on the benefits of having sufficient funds to support operating activities without liquidity risk and the cost of financing that working capital. So some benefits of investing in working capital is that customer demands can be met. Credit sales can also be provided to the customers, and cash will also be available to meet the immediate demands of the entity. However, when there is excessive investment in working capital, what we are saying is that we'll have a situation of profits being reduced from the investment in wealth-producing assets and long-term projects. Average investment in working capital times the annual cost of finance will give us the annual cost of working capital investment. So the level of working capital investment in an organization is often a policy decision, and this is dependent on the length of the working capital cycle. So this measures the time taken from the payment made to suppliers of the various raw materials we need to the payment received from the customer. This is affected by the terms of trade, which is amount of credit given to customers compared to credit taken from the suppliers. Example, when you have the manufacturing industry, it has a longer cycle than in a retail industry, as raw materials will be held in inventory before used in production, then produced and purchased by a customer before we even think of claiming our payment from the customer. The second one is the management attitude to risk. So high levels of working capital are expensive, but low levels are also high risk. An aggressive working capital policy is to keep the minimum working capital, leading to risk of not supplying customers, stockouts, high idle time, tight credit control, but will be cheap to finance with a potential to increase profitability. A conservative working capital policy, on the other hand, keeps adequate working capital for the organization's need. Risk-seeking managers prefer aggressive policy, while risk-averse would prefer the conservative policy. So working capital can be permanent working capital, where there is a minimum level of working capital required all of the time, and there is fluctuating working capital where it's required at certain times in the trade cycle. Temporary finance will be required to fund the purchases. A seasonal demand entity will require a fluctuating working capital. And the type of finance used also depends on management's attitude to risk, which includes an aggressive funding policy where long-term finance for non-current assets and short-term finance are used for working capital requirements. It could also be a matching funding policy where long-term finance for non-current assets and permanent working capital. Short-term finance will be for fluctuating working capital requirements. And the last funding policy is the conservative funding policy, where long-term finance for non-current assets, permanent and a portion of fluctuating working capital, and then minimal short-term finance is used in the conservative funding policy. Benefits of short-term finance are lower cost. Example, we have trade credit, which you could obtain from your suppliers, and there is much more flexibility like the bank overdraft. Now, risk of short-term finance are the quick usage, and it can be demanded at any time by the bank. So we'll look at the cash operating cycle, which is the average length of time between paying suppliers for goods and services received to receiving cash from customers for the sale of these finished goods and services. This is linked to the business operating cycle, which is the average length of time between obtaining goods and services from suppliers to selling these finished goods to the suppliers. So the difference is that with the cash operating cycle, there is that element of cash being introduced. Each industry has different cash operating cycle. Example, we have a holiday tour, manufacturing, retailing industry. They all have different cash operating cycle. The cash operating cycle must therefore be managed to ensure that the investment in working capital is not excessive nor too small. The working capital ratios and the length of cash cycle should be monitored over time. Now look at the inventory turnover period. So if possible, average inventory should be used to calculate the ratio because the year-end inventory level might not be representative of the average inventory in the period. However, the year-end inventory should be used when opening inventory is not given, and average inventory cannot be calculated. So if annual purchase is also given in computing our inventory turnover period, it might be more appropriate to use that instead of cost of sales. So for a manufacturing company, raw material turnover period will be equal to the average raw material inventory divided by the annual raw material purchases times 365. That gives you the number of days for the raw material turnover. Production cycle will be average work in progress divided by the annual cost of sales times 365. Finished inventory will be equal to average finished inventory divided by the annual cost of sales times 365. An inventory turnover period for a manufacturing company is therefore the A, which is the raw material turnover period, plus the production cycle minus the finished inventory period. Now, inventory turnover is equal to cost of sales divided by inventory. So if average inventory turnover period is 2 months, this means that the inventory is turned over or used on average 6 times each year. So we have this simple diagram which shows that average inventory holding days is equal to inventory over cost of sales times 365. Average receivable days, trade receivable divided by credit sales times 365. And average payable days, trade payables over purchases times 365. So the inventory days plus the receivable days minus the payable days will give the operating cycle. So average collection period or the average receivable days. So when normal credit terms are offered to customers are 30 days, then the average collection period should be 30 days. But where it exceeds 30 days, this indicates that some customers are taking longer to pay than they should. And this might indicate inefficient collection procedures for the receivables. And with average payable period, this is the average period of credits taken from suppliers before the payment of trade payables. This should be close to the normal credit terms offered by suppliers. If shorter than industry average, then the company did not negotiate well, or invoices are paid much sooner, which is inefficient working capital management. If longer than the industry average, then the company has negotiated very well and cash flow problems, or it indicates unethical business practice of non-compliance with the credit terms. So we'll look at some extract from the statement of financial position and the statement of comprehensive income. So raw materials being 864,000, work in progress 448,128, finished goods 1,567,893, trade receivables being 425,600, trade payables. We have our annual purchase, we have our annual cost of sales, then our annual sales. So the question is to calculate the length of the cash operating cycle for the company. The length of the cash operating cycle for the company. So our raw material turnover period will be 864,000 divided by the 1,745,000, which is our annual purchases, times 365. And the work production cycle will be 448,128, which is the work in progress, divided by our annual cost of sales. And then we have the finished goods turnover, which is 1,567,893, divided by the annual cost of sales, 5,272,128. And the credit period, which is the trade payables, which is the trade receivables, sorry, 1,425,600 divided by your annual sales. So all of these minus your credit period from suppliers, which is 604,800 divided by the annual purchases. So you do all of these times 365 to give you the number of these. So when you do that, you'll be getting a raw material turnover of 181, production cycle of 31, finished goods turnover of 109, receivable days of 90, payables 127. And then when you do the summation, that's all of those above minus your payable days, you get your cash operating cycle. Okay, so we are now looking at how we are going to analyze the cash operating cycle. So it can be analyzed to assess whether the total investment in working capital is too large or possibly too small. The analysis can be made by comparing each element of the cash operating cycle or as a whole, while the industry results and entities prior year results. So you're either comparing it to the industry performance or the prior year results of the entity. So in comparing it to other companies in the industry, as a general rule, the inventory turnover period, that's the average collection period and average payment period, should be about the same for all companies operating in the same industry. There are therefore reasons for differences, such as usually large proportion of sales to other countries, hence there is longer collection period due to delay in making deliveries. And also there could be efficient or inefficient working capital management, where there are these differences when we compare it to the industry. We can also do a comparison with the previous years. So that's where we are looking at a trend. So there might be a noticeable trend over time in the company's turnover ratios, which should be investigated. Reasons could be that there is one, inefficient inventory management causing excessive inventories, hence longer inventory turnover period. And there could be inefficient collection procedures, hence there is longer average collection times. So this will be our hints for investigation into the working capital management of the entity. Now, there could be some changes in the cash cycle, and these often have implications for the operation cash flow. So where there are changes in the length of the cash operating cycle, this has implications for the cash flow as well as the working capital management. A longer cash operating cycle, giving no change in sales or cost of sales, increases the total investment in working capital. An increase in working capital reduces the operational cash flows. And a shorter cash operating cycle results in less working capital investment, which increases the operating cash flow in the period. So look at other working capital ratios. First of all, we have liquidity. So liquidity for an entity means having access to sufficient cash to meet all the payment obligations when they fall due. So main sources of liquidity for a business are the cash flow from operations, holding liquid assets, and access to a committed borrowing facility from a bank. Example, a revolving credit facility. So liquidity can be assessed by analyzing liquidity ratios and length of its cash operating cycle. So some liquidity ratios, we have the current ratio, which is current asset divided by current liabilities. A quick ratio, which is current assets excluding inventory, divided by current liabilities. So you should remember to use the closing balance sheet values to calculate these two ratios and include all current assets and all current liabilities. If liquidity ratios are too high, there is too much investment in working capital. And if they are low, it means there is not enough liquidity and at a risk of being unable to settle liabilities when they fall due. So to assess, we can compare this with those other companies in the same industry, or we can consider the previous periods, its performance. So ideally, liquidity ratios are 2:1, which is the current ratio, and 1:1 for the quick ratio. So when ratios are below these levels, then management might need to improve liquidity. The normal liquidity ratios vary significantly between different industries. A high ratio might be attributable to an unusually large holding of cash. The most appropriate way of using liquidity ratio is probably to monitor changes in the ratio over time. If inventory is held only for a short time before it is used or sold, the current ratio is probably a more useful ratio because inventory is a liquid asset. And if inventory is slow moving and fairly illiquid, then the quick ratio is a better guide. Okay, so we are still on other working capital ratios. So we have the sales revenue, which is the net working capital ratio. So this assesses whether the investment in working capital is too large or insufficient. So this is because it might be assumed that the amount of working capital should be proportional to the value of annual sales, because there should be a certain amount of working capital to support a given quantity of sales. So net working capital is equal to your total current asset minus your total current liabilities. Then we'll look at overtrading. So overtrading is carrying on an excessive volume of trading in relation to the amount of long-term capital invested in the business. A company that is overtrading has inadequate capital for the volume of sales revenue that it is earning. This is most common in small companies expanding rapidly with a very high rate of sales growth. So we have some symptoms of overtrading. There could be high rates of annual sales growth. There could be low profitability. Retained profits are also low. There's large increase in inventory and trade receivable due to growth in the sales. There's always a need to acquire some new non-current assets to support the growth in the sales volume. And growth in assets has to be financed by equity and liabilities. There's also increase in current liabilities, which takes the form of much longer time to pay suppliers and very big increase in its bank overdrafts. So still on overtrading, some consequences of overtrading and possible remedial action. So first of all, overtrading leads to eventual insolvency unless remedial measures are taken. So insolvency will occur if the sales continues to grow and overtrading continues, because a company cannot finance its growth in business indefinitely with the growth in current liabilities. So the company's bank will eventually refuse to allow more overdraft and withdraw existing overdraft facility if it believes that the company cannot repay. Suppliers may also eventually refuse to allow longer credits. Overtrading therefore eventually leads to inadequate liquidity due to insufficient long-term capital funding. So what are some remedial actions? So to achieve a better ratio of long-term capital to sales and a suitable level of working capital investment, we do this by one, reducing the volume of business, and two, we can also increase capital by raising more retained profit from increased profits. However, improving profit means company might not have time to build up cash flows and profits soon enough. The banks may withdraw its overdraft facility without notice, and it will make the company insolvent. So we go to inventory management as one of the working capital management. So there are certain costs associated with inventory. Many companies might hold large amounts of inventory to meet the needs of customers as soon as it rises. However, this comes at some cost. So one, we have the purchase price of the inventory itself, which is featuring as one of the costs of holding of inventory. We have the reorder cost, which is includes delivering, placing an order, checking the inventory after it's delivered, batch setup cost. All of those things form the reorder cost, which also is a cost. We have the holding cost, inventory holding cost, which includes insurance, your warehouse costs. There could be theft, deterioration, and even cost of capital is tied up while you have inventory sitting there waiting for you to use them. And also there could be shortage costs, which is lost profit on sale, future loss of profit, production stoppage due to shortages. Capital is tied up in inventory, and the capital investment also has a cost. So changing inventory levels will affect variable inventory holding costs, but not the fixed cost. There's always a trade-off between holding costs and ordering costs. The average inventory falls as the order size falls, thus reducing the holding cost. And the relevant cost for both costs must be considered when making a decision on quantity to order. Then we go to EOQ, or economic order quantity, which is a mathematical model which is used to calculate the quantity of inventory to order from a supplier each time that an order is made. The aim is to identify the order quantity for any item of inventory that will minimize the total annual inventory cost. The assumption for EOQ is that there is no bulk purchase discount for making orders in large sizes. All unit purchase costs have the same unit price. And the order lead time, that's the time between placing order and receiving delivery, is constant and known. And also annual demand for inventory item is constant throughout the year. So EOQ, the formula is a square root of 2 COD and all divided by CH. So the Q there represents the quantity purchases in each order to minimize the cost. CO is the fixed cost per order, or you can say the ordering cost. CH is the cost of handling one item of inventory per annum, the holding cost. Then D is the annual demand. So from this formula, we can say the maximum quantity to order is the Q unit. Average inventory held is the Q divided by 2. The total holding cost is Q divided by 2 times your CH. The number of orders per year is D divided by Q. And your total ordering costs each year are the D divided by Q times the CO. Now, EOQ minimizes the sum of these costs given the assumptions. So we'll look at an example. So a company uses 120,000 units of material X each year, which costs 300 cedis for each unit. The cost of placing an order is 6,500 for each order. And the annual cost of holding inventory each year is 10% of purchase price of a unit. So we should find the EOQ. So we should know that the CO, which is the ordering cost, is 6,500 per the question. Our CH, which is the holding cost, is 10% of the purchase price. So 10% of 300. And then the D is the annual demand, 120,000. So using the EOQ formula, we have 7,211.1 units as our economic order quantity. So EOQ is the quantity that minimizes the sum of the annual order cost and the annual holding cost. The annual holding cost equals the annual order cost at this particular level. So the purchase price is irrelevant in deciding the order quantity because it is not affected by the order size when the annual demand is constant. Total annual ordering costs and annual holding costs are always the same whenever the purchase quantity for materials is the EOQ. And the assumptions apply. This would not be the case if safety inventory was held. So look at another example. So a company uses the EOQ model to determine the purchase order quantities for materials. The demand for material item M456 is 135,000 units per year. That's the annual demand. This item costs 100 cedis per unit, and the annual holding cost is 5% of the purchase cost per year. The cost of placing an order for the item is 240 cedis. So what are the annual holding costs for the material item M456? So from this question, we are looking for the various variables to help us find our EOQ, which will help us find our annual holding cost. So our CO, which is the ordering cost, is 240 cedis per the question. Our CH, which is the holding cost, is 0.05 or 5% times the cost of the item, which is 100 cedis. Our D annual demand is 135,000. So when you use the EOQ formula, you should be getting 3,600 units for the EOQ. Now the annual holding cost is our EOQ divided by 2 times our holding cost. So 3,600 divided by 2 times 5 to give us 9,000 cedis, which is our annual holding cost. At this level, when you find your annual ordering cost, it should also give you 9,000. So when the EOQ formula is used to calculate the purchase quantity, it is assumed that the purchase cost per unit of material is a constant amount, regardless of the quantity. If discount is offered above a certain quantity, then the purchase price becomes a relevant cost. Here, the EOQ that minimizes total cost will either be the EOQ or minimum order quantity necessary to obtain the price discount. So we'll move to reorder level and buffer stock. So inventory reorder level. So the risk of running out of inventory is due to supply lead time, which is a period between placing a new order and receiving the delivery of item, and uncertain daily or weekly usage, which is during the supply lead time, actual usage of material may be more than or less than the average usage. So reorder level to avoid stock out and buffer stock. To avoid stock out, your reorder level at which new orders are placed must be set. Where supply lead time is certain, our reorder level, ROL, is equal to the demand for item per day or week times our lead time in days or weeks. Where lead time is uncertain, our reorder level is maximum demand for item per day or week times our maximum supply lead time in days or weeks. Now, our safety inventory or our buffer stock, the reorder level is therefore set at a maximum expected consumption of the material item during the supply lead time. So our average inventory is equal to Q/2 plus your safety inventory. And the safety inventory is the amount of inventory held in excess of average requirements in order to remove the risk of stock out. Safety inventory is equal to your reorder level, which is multiplied by your maximum demand per day times your maximum lead time minus the average usage in lead time period, which is the average demand per day times your average lead time. The cost of holding safety inventory is the size of the safety inventory multiplied by the holding cost per unit per annum. And the maximum inventory level is the level above which the company would incur extra holding costs without adding any benefit to the company. If it exceeds, something unusual has happened to either the supply lead time or the demand during the lead time. Both are uncertain. So our maximum inventory lead is equal to your reorder level plus your reorder quantity minus your minimum demand times your minimum lead time. It should occur at the time that a new delivery of the item has been received from the supplier. Then we go to your minimum inventory level. It's the level below which it will be dangerously low for inventory to fall. So minimum inventory level is your reorder level minus your average demand times your average lead time in days. So we'll look at an example. A company uses material item B667. The reorder quantity for this material is 12,000 units. There is some uncertainty about the length of the lead time between ordering more materials and receiving delivery from the supplier. So there is also some variability in weekly demand for the item. The supply lead time, which is in weeks, the average is 2.5. The maximum period is 3. The minimum is 1. Demand per week in units, average is 1,200. Maximum is 1,500. Minimum is 800. So we are being asked to find the reorder level, safety inventory, maximum and minimum inventory levels. So the reorder level is the maximum demand for the material item per day, which is 1,500 units, multiplied by the maximum lead time in days or weeks, which is the 3 weeks. So the reorder level becomes 4,500 units. Now to find your safety inventory, first of all, we have your reorder level, which is 4,500. And your average demand per week, which is 1,200 units, you multiply by your average lead time in weeks, which is 2.5 weeks. That gives you 3,000. So your reorder level minus this particular 3,000 you will get is 1,500, which is your safety inventory. Now your maximum inventory level, first of all, you start from your reorder level, which is 4,500. Your reorder quantity is 12,000. And your minimum demand per week, is 800 units. You multiply this to your minimum lead time, which is 1 week, to give you 800. And when you do the math, you get your maximum inventory levels of 15,700. And also your minimum inventory level is your reorder level first, which is 4,500. Your average demand per week is 1,200 units. Your average lead time per week is 2.5 weeks. And when you do the math, you get a minimum inventory level of 1,500. So your minimum inventory level is the buffer stock quantity. And that's how you go about that. So we could also use a probability table to decide the optimal reorder level. So for each possible reorder level under consideration, we can calculate the probable demand in lead time. So when a company is prepared to accept the risk of stock out, the optimal reorder level might be estimated using the probability of demand to calculate the reorder level that has the lowest expected value of the total cost. A probability table can be prepared for each possible reorder level under consideration. We calculate the probable demand in lead time between order and delivery, the risk of having excess inventory or buffer stock and its cost, the risk of stockouts and their costs, and the reorder level selected might be the reorder level at which the expected value of cost is minimized. Now we go to JIT inventory management, or just-in-time inventory management. So JIT production or purchasing, it originated in Japan in 1970s with a principle that producing items for inventory is wasteful because inventory adds no value and holding inventory is therefore an expense for which there is no benefit. Raw materials are therefore obtained only when they are actually needed. Hence, we have the JIT production where no inventory of finished goods are kept. Items will be produced just in time to meet the customer demands and not before. And we have JIT purchasing where no inventory of purchased materials and components. So purchase should be delivered by external suppliers just in time for when they are needed in our production. So the practical implications of JIT just in time is that it's important that items should be available when they are required. In practice, this means that production times must be very fast and production must be very reliable, and there must be no holdups, stoppages, or bottlenecks. Now, deliveries from suppliers must also be reliable and of high quality. JIT purchasing, it depends on efficient and reliable supply arrangement with the key suppliers and excellent relationship. So you agree with me that collaborative long-term relationships should be established with the major suppliers, and purchasing should not be based on selecting the lowest price offered by the competing suppliers. So we can reduce or eliminate inventories and work in progress. We can reduce order sizes since the output is produced to meet specific demand, and raw material delivery should be timed to coincide with the production requirements. And we can also ensure deliveries arrive in the factory exactly at the time that they are needed. So the overall emphasis of the JIT purchasing policy is on consistency and quality rather than looking for the lowest purchase price available. Now, there are some problems with JIT. So zero inventories cannot be achieved in some industry where customer demand is uncertain and production cycle is quite long. It's also difficult to arrange a reliable system with key suppliers. If the EOQ model succeeds in minimizing total holding costs and ordering costs, then JIT system may be high. So I want to thank you for staying with me till this point. Kindly follow the link below to join the Telegram channel for paper 2.4, where you can have access to the slides, marking scheme, to all the examples discussed in this session and other relevant material to aid your preparation. I would like to thank you once again, and I'll see you in the next session.